Hi, it's Michael Farr at Farr, Miller and Washington. Been a wild ride this week for markets. We seem to be settling out. Stocks seem once again this morning to have caught a bid. That means they're going up. There's more green on the screens behind me. But that was the case yesterday at this time, and we ended up closing down 200 points on the day. We've made that up about exactly this morning, so up 200 points. Tough to know whether that's going to mean anything. We have the S&P 500 trading above 1900 again, but just barely. The dollar is stronger, $1.14 against the euro. Oil, $39.28. Gold, down. Now, this has been interesting to me because typically one of the fear gauges is the price of gold. When money gets scared and the dollar gets stronger, you do expect to see fluctuations in the price of gold, but the fear going in should have taken gold a little higher, I think. But anyway, we haven't seen that fear trade. We've seen the fear trade kind of round trip this week in the Treasury 10-year note. Yields fell because prices went up and took the yields down to 1.97 or 1.98 on the 10-year. This morning, we're back up at 2.13%. That 15 to 16 basis point swing on a 10-year Treasury in 3 days is really significant. I mean, that's huge. So what's going on? The answer is we don't know exactly. There's not a lot of new data out of China. And we know that investors have been scared. We saw real fear on Monday, and it was, I guess, inoculated, if you will, by actions from the Chinese central bank. And of course, markets went back up for most of Tuesday, sprang back and down, of course, into that close. So this volatility seems to be part of the new normal. And when things are volatile, people tend to get emotional. We've said over and over, emotional decisions will really hurt you. We're trying to make strategic decisions, and indeed we've put a little bit of money to work that had been sitting on the sidelines. This is a time when you need to be patient and you need to be disciplined. If you have a 401k, remember that you're going to buy more shares at the end of August at these lower levels than you were able to buy at the end of July. Keep investing. That's part of your long-term retirement strategy. Markets went down in 2008. If you sold, you got burned. If you still own those stocks, you're a happy person. Same thing for all of the other stock market corrections. We live in a very turbulent world that has not been turbulent for markets in quite a while. It takes a bit of getting used to. I would encourage you to get used to it. Know that it's going to be part of your investment experience for a bit, but that doesn't change your long-term goal or your long-term needs of wanting to retire and be able to provide a better tomorrow for you and your family. So stick with your discipline. If you need a little bit of help, give us a call at Farr, Miller and Washington. In Washington, D.C., I'm Michael Farr, keeping my powder dry.